All right, welcome to the Explainer. Today, we're digging into a major analysis that suggests the whole game of investing is about to change for the next decade and a half. The old maps won't work anymore. So let's break down the new one together. Okay, let's just jump right in with a number that pretty much sets the stage for everything else we're going to talk about. $323 trillion. That's the staggering amount of global debt we're dealing with today. And a number that big doesn't just sit there. It fundamentally rewrites the rules for investors. So this mountain of debt, it's created a totally new economic reality. And that brings us to our first really big idea, a concept you're going to hear a lot more about: fiscal dominance. So what on earth does that mean? Well, in plain English, it means governments are in a trap. Their debt is so massive that the central bank, think the Federal Reserve, basically has its hands tied. It can't use its main tool, raising interest rates, to fight off inflation like it normally would. Why? Because if it did, the government's interest payments would explode and could trigger a massive crisis. This is a huge deal because it takes one of the most important economic tools right off the table. And look, this isn't some abstract economic theory. This is where the rubber meets the road. For years, the biggest line item in the U.S. budget was Social Security. But take a look at this. The interest payments on the national debt are growing so fast, they're on track to become one of the absolute biggest government expenses. It's basically eating up the budget for everything else. This isn't some problem for the future, it's happening right now. Okay, so that debt situation, it feeds directly into our next big challenge, especially if you're invested in the U.S. stock market. And that is historically high valuations. We've all enjoyed an incredible run, for sure. But the price you have to pay to get into the U.S. market today is, well, it's extremely high. And this number, 38, tells you just how high. It's called the Shiller CAPE ratio, and it's a way of measuring long-term stock market value. Think of it kind of like the market's temperature. A normal, healthy average is somewhere around 17. Today, we're at 38. That's not just warm, that's a serious fever. In fact, it's a level that we've only seen twice before, right before the dot-com bubble burst and just before the Great Crash of 1929. And here's the kicker. This isn't just a number. History tells us exactly what happens next. When that CAPE ratio climbs up past 26, the average return for investors over the next 10 years has been, well, a pretty miserable 0.9%. That is a world away from the double-digit returns many of us have gotten used to. It's a really sobering thought.
So what's the takeaway here for the next, say, decade or so? Well, major firms that forecast this stuff, like Vanguard, are now saying they expect U.S. stocks to return maybe 3 to 5% a year. But, and this is a big but, they expect international markets to deliver 7 to 9%. That's a massive performance gap, and it all comes back to that starting point. U.S. stocks are just really, really expensive right now.
All right, so on top of expensive stocks, we've got another layer to this whole puzzle. There's a slow, quiet, but steady shift happening with the world's #1 currency, the US dollar. Now, it's super important to be clear here. The analysis isn't screaming the dollar is gonna collapse. Not at all. What it's pointing to is a gradual transition. The dollar's piece of the pie when it comes to global reserves held by central banks has already dropped from over 70% down to about 56%. The forecast is for it to dip below half by 2040. It's not about the dollar disappearing, it's about it becoming the largest among equals instead of the undisputed king. So how do we know this isn't just a random fluctuation? Well, the clearest signal is right here. The world's central banks have been buying gold like crazy, over 1,000 tons for 3 years running. That's more than double the average pace from the decade before. This isn't an accident. It's a deliberate, coordinated strategy by other countries to diversify away from holding so many US dollars. You know, to really wrap our heads around what's at stake when a dominant power starts to face these kinds of challenges, history gives us a couple of powerful stories with two very different endings. On the one hand, you've got the cautionary tale, Japan. In 1989, its stock market was the biggest in the world, and then the bubble burst in the most catastrophic way. It took investors 34 years, a whole generation, just to break even. Then, on the other hand, you have Great Britain. Its global dominance faded, sure, but it was gradual. Its market underperformed, but it was an orderly process that still gave investors positive returns. The lesson here is about the path it takes. Is it a gradual adjustment, or is it a sudden catastrophic pop? Okay, so that brings us to the big question, right? The most important part of this whole explainer. We've laid out all these challenges: massive debt, sky-high valuations, a shift in currency.
So what do you actually do about it? How do you position your money for this completely new world?
So the answer here, according to this analysis, is not to panic. It's not about selling everything and running for the hills. It's about smart, intelligent repositioning. It's about shifting from a portfolio that worked great for the last decade to one that's built to be more resilient for the next one. Now, a lot of us, maybe without even realizing it, have a portfolio that looks something like this. It's super concentrated in US stocks, maybe around 70%. And after the incredible run the US market has had, that feels totally normal. But given everything we just talked about, this actually represents a huge concentration risk. So here's the proposed shift. It's all about strategic rebalancing. You take that heavy US exposure and bring it down from 70% to a more balanced 45%. Then you take that money and put it to work elsewhere, bumping up your international holdings and, this is a key part, adding a 10% slice of gold and other real assets, which can act as a great diversifier. And look, the goal here is twofold, and this is really important. Yeah, it's partly about trying to squeeze out a little extra return, maybe 1 to 1.5% per year, but more importantly, it's about building a much stronger defense. This kind of portfolio is designed to cushion the blow in a major crash, and that ability to limit your losses is what keeps you in the game instead of panic selling at the absolute worst time.
Okay, so let's bring this all home. What does this mean for you? What can you actually do? The analysis lays out some pretty clear, actionable steps to get from that old portfolio to the new one.
The report boils it down to 3 immediate actions to get your portfolio aligned with this new reality. First, dial back that heavy concentration in US stocks. Second, start adding some exposure to international markets, using simple, low-cost ETFs. And third, begin building a starter position in a gold ETF to act as that portfolio insurance. And that quote really sums up the entire philosophy here. This isn't about being a bull or a bear. It's not about trying to time the market perfectly. It's about being a realist. It's about taking that prudent middle path that gives you a solid balance of opportunity and safety. It's about having a map that prepares you for the journey no matter what the road ahead looks like.